ladies and gentlemen. Today, we're diving into a topic that has been stirring up a lot of debate both inside and outside of China NIO's latest share offering. On the surface, the headlines may look negative. $1 billion raise, nearly 8% dilution, and the stock immediately taking a hit. At first glance, this seems like bad news all around. But as always, there are multiple perspectives to consider. There's a bullish angle, there's a more neutral or cautious take. And then, of course, I'll also share my own personal opinion about what all of this might mean for NIO in the short term and in the long run. So let's break this all down together. This is not financial advice. Please do your own research. NIO recently announced a massive offering of 181 million shares at a price of about $5.57 per share. That translates to around 8% dilution, which is not a small figure. In total, this brought them roughly $1 billion in fresh capital. Naturally, when a company issues that many new shares, the stock price gets hit and momentum disappears. That's exactly what happened here. But what's done is done. The market reacted, and the dilution is already baked into the current share price. The bigger question now is, why did NIO make this move, and what does it signal for the company's future? Let's start with the optimistic angle. The most important part of this whole story is timing. Why now? Why did NIO decide to raise so much money at this specific moment? Well, one key detail is that 74% of the cash from this offering went directly into NIO China. This is not just about keeping the lights on. This is about strengthening NIO's stake in its China operations before profitability becomes a reality. Here's the bullish logic. Once NIO hits profitability, whether that happens in Q4 or a bit later, the valuation of NIO China is expected to skyrocket. If NIO waits until that point to buy a larger share of NIO China, it would cost them far more. By using their US-listed entity, NIO Inc., to inject cash right now, they're essentially locking in a cheaper price for future growth. In other words, management seems confident that NIO China will be worth much more after profitability. So buying as much ownership as possible before that milestone makes financial sense. It's like investing in yourself at a discount before the value shoots up. That's why many investors see this move as bullish. It's a long-term play, signaling that NIO is preparing for a future where profitability is not just possible but likely. Now, let's take a step back and look at what people in China are saying. Social media chatter has been mixed, and not everyone is convinced this was a move made out of strength. One common opinion is that profitability in Q4 may actually be too ambitious. Some feel management itself doesn't have full confidence in hitting that goal, and that's part of the reason why they went for dilution now. Why the doubt? It comes down to production capacity. Take the ONVO L90, for example. The demand looks great, orders are flowing in, the ES8 is also performing well. But production tells a different story. Right now, the company isn't expected to fully ramp up ONVO L90 production until December. By then, they could hit around 15,000 units a month. But here's the catch: production numbers don't equal deliveries. Cars built in December might not actually reach customers until January. And once you're in January, everything changes. That's when higher purchase taxes kick in, subsidies shrink, and consumer urgency drops. People want their cars before the year ends so they can take advantage of the better policies. If NIO can't deliver quickly enough, many of those buyers might just switch to competitors who can put the cars in their driveway before year end. So critics argue that the dilution wasn't just a strategic long-term move, but also a safety net because NIO might not realistically hit 50,000 monthly deliveries in Q4, the number they need for profitability. A big piece of this puzzle is factory number 3. On paper, it's complete. Staff are being trained, equipment is in place, and everything looks ready. But the reality is, production hasn't really ramped up yet. For NIO to achieve its goals, that factory needs to be operating at full steam, producing and delivering cars without delay. If production lags, then even with strong demand, customers will face long wait times. Right now, for the ONVO L90, The wait is already about 2 months. In September, that means deliveries push into November. By October, that wait stretches into December or even next year. And if deliveries slip into next year, as we discussed, the financial math for customers changes and many may cancel. That's why some Chinese social media voices remain skeptical. They see the dilution as a defensive move in case deliveries and profitability targets slip further than expected. Now let me share my own perspective. I really want to see NIO reach profitability, and I do think it's possible, but not necessarily in the way some people expect. Yes, 50K monthly deliveries will be tough to achieve. I think that number might be a stretch for Q4. But profitability isn't only about selling more cars, it's also about cutting costs. And NIO has already taken huge steps in that direction. They've shut down underperforming stores, laid off excess staff, trimmed headcount at headquarters, and significantly reduced operating expenses. Those cost cuts alone could bring them much closer to profitability, even if delivery numbers fall a bit short. Combine leaner operations with steady, though maybe not record-breaking, deliveries, and profitability might still be within reach. As for dilution, I see it as a necessary trade-off. Yes, shareholders took a short-term hit. But the flip side is that bankruptcy risk is effectively off the table. NIO now has a fresh $1 billion in the bank. And if needed, they can always tap the market again. Companies with access to capital don't just collapse overnight. So while it's not all sunshine and roses, I see this as a stabilizing move. In the long term, it could actually pay off if management executes properly and gets production where it needs to be. So, to wrap it all up, the bullish perspective is that NIO raised money now to buy more of NIO China before profitability makes it far more expensive. It's a long-term strategic move that signals confidence in future growth. The neutral or cautious perspective, especially from voices in China, is that management might not actually believe they can achieve profitability in Q4, given production delays and factory ramp-up issues. That's why some see this dilution as a safety net. And my personal view is somewhere in between. I think 50K monthly deliveries will be difficult, but cost-cutting may still push them into profitability territory. And dilution, while painful, removes the fear of bankruptcy, giving the company breathing room to focus on execution. At the end of the day, this is a turning point for NIO. If they can ramp up production, deliver cars before the year ends, and maintain the cost discipline they've already started, this dilution could look like a smart move in hindsight. If not, then the skeptics may be proven right. Either way, the next few months are going to be absolutely critical for NIO. Thank you for joining us today. If you enjoyed the video, don't forget to hit the like button and subscribe to our channel for more stock predictions and market insights. Remember to turn on the notification bell so you never miss an update. Happy investing, and see you in the next video.